Hi there, welcome to another Mortgage Minute where we talk about what is a mortgage. I had someone ask me that and I thought actually that's a really good question. So a mortgage, because the terms, obviously we all know what we think we mean by mortgage, but mortgage actually can have several definitions. So a mortgage is first of all, a debt, a loan against a secured property that you're offering as security. So we wouldn't call a car loan a mortgage. So a mortgage is a loan or a debt against real estate for the most part. And a mortgage is also the security instrument or the lien that's put on that property to evidence or to show the public that you have a loan against a property. So a mortgage is a loan against real estate secured by that real estate, meaning if you don't pay the loan, the debt, the lender can take the property to satisfy that debt. So that's number one. And a mortgage generally is a loan that's paid over time for a specific amount of time, except for a reverse mortgage, it goes indefinitely based on the life of the person who owes the money. So a mortgage is also a mortgage payment. So some people, when they say, oh, my mortgage is, they mean their mortgage payment. So a mortgage payment is the monthly payment that you pay to satisfy that debt. So usually that's for 15 years, 20 years, 30 years, a certain amount of time. And if it's a fixed rate mortgage, that payment is level the whole time. So the whole 30 years, for example, you're paying the exact same amount, only in the beginning of the loan debt payoff, and we call that amortization. So in that schedule of amortization or paying off the loan, each payment will have less interest and more principal, kind of like a scale. In the beginning, it's heavily interest and just a little bit of principal. And over time, the interest is going down and the principal amount is going up. So to show you how that would work, I decided to show you an amortization table. Fun fact, amortization actually comes from the root word for death, French word mort. So mort is a word that means death. So you're killing off this debt. So I wanted to share this real quick table. That's the yearly schedule of a mortgage for $480,000 at 7% interest. And that payment for principal and interest should be $31.93. And you can see in the entire year, $4,800 went to almost $4,900 went to principal, and interest was $33,000. So just about 10 or 12% of the mortgage payment goes to principal pay down, paying off the debt. And you can see the balance instead of 480 was 475 at the end of the year. And you can see every year, if you look at the principal paid column, that's the debt that we're killing. That mortgage debt is going down by this amount. So you can see in the far right corner, the balance is coming down till eventually in year 30, we have a zero debt. So if we look at it monthly, what I was describing earlier is a mortgage can be broken down into the principal amount and the interest amount. And if we look at this monthly scheduled payment of $31.93.45, we've got an amount of $300 and some for principal and $2,900 or $2,800 for interest. And you can see month by month the balance coming down. So you can see that every month there's a little bit more principal going to paying off the loan and a little less interest going to the bank for paying off the loan. So right around year 15, if you can follow along with me, year 15 is about payment 180. So if we go to payment 180, we now have same mortgage payment because we chose a 30-year fixed rate. So we're paying the same the whole way through, but the principal and interest amount shifts. So at 7% interest at year 15, we have $1,100 in principal, $2,000 in interest, $2,075 in interest. So let's keep going and see where our break-even point is. It's right around. It is right around payment 240. We'll call it around payment 242. Let's see. Yeah, we'll say the closest it gets is actually payment 242 is our break-even point where our mortgage payment is 50% principal, 50% interest. The lower your interest rate is, the sooner that happens in the schedule. So if you have a mortgage payment and you want to know how you can kill that debt sooner, be sure to look at our mortgage minute on 3 ways to kill the debt faster on a mortgage. So I hope this was helpful to you. The mortgage is both a debt, it's a lien on the property, and it's a payment. So people use that word for all 3 of those. And then lastly, your mortgage payment sometimes includes principal and interest, where you have those wrapped into the loan so that the lender will pay your taxes and insurance for you. So they budget you 1/12 of each of those things and wrap it into the mortgage. And so when people say my mortgage is X amount, sometimes that includes principal and interest. And we call that either the impound account, which sounds kind of weird, or the escrow account. So I hope you enjoyed this Mortgage Minute, and I hope you'll join us again soon.